Hello, I'm Andrew Burtz, one of the shareholders here at Doty Pro Wilson. We want to take a few minutes today to talk to you about the reconciliation bill in Congress that's getting connected to the infrastructure spending bill and the tax changes and regulation adjustments that are being proposed within that bill. We have with us today Don Leavitt, one of the senior managers and CPAs here in our office, to just kind of go over some of those proposed regulations. At this point, they're still in that non-finalized, proposed, however you want to say that. Some of them are sure to be changed, but as of today, this is what we know to be true and what they're talking about. So let's get into this and we'll kind of talk about what some of those are. So Don, tell me about what I'm hearing with regard to Roth IRAs completely going away.
So Roth IRAs won't be going away. The biggest change that's going to be coming about is what you can hold within an IRA, whether traditional or Roth, and then also some limitations on when you can convert traditional IRA money into a Roth IRA. So one of the proposed regulations and proposed changes that's coming into play here is non-publicly traded investments, so anything that's not publicly traded would not be eligible to be held in an IRA anymore. There would be a 2-year transition period, but anything left in there would be a deemed distribution subject to early withdrawal penalties and all those fun things. What that means is if you have an IRA that say holds a rental property or an interest in a partnership or anything like that, you're going to want to get together with us to decide, okay, what's the best way to handle this now non-qualified, dare I say it, illegal investment in your IRA. On the conversion side of things, right now the regulations are going to be focusing more on high income, high net worth individuals. They're proposing the changes only apply to people with more than $10 million in their IRAs and with income over $450,000 if you're a married couple.
So what happens if I have a client that has $10 million in their IRA? I mean, they could give some to me, I'm sure, but what are they going to make them do?
Well, so what's going to happen is, again, this is proposed, and this only applies to traditional accounts, is they're saying any amount over 10 million, your required minimum distribution is going to be half of that overage. So if you have $15 million in an IRA and this law is in effect, your RMD would be $2.5 million, which is half of the $5 million in excess of 10. And you just repeat that exercise every year until you get below the $10 million mark. From a planning perspective, we have a unique opportunity this year where if you are thinking you're going to be in that situation, depending on what your plans are for that IRA money, it may be advisable to withdraw that now, assuming you're at retirement age, and particularly if you have a charitable bent, give that money to charity. Reason being that this year we have 100% AGI limitation on cash contributions. And so we can get that money out of the IRA, avoid the RMD issue entirely in the future, and still serve our charitable purpose that we want to have.
Side note, what happens if I don't want to give a charity one big lump sum of $2.5 million?
Another option could be something like a donor advised fund. Those are something that we have a number of clients using currently to allow for these lump sum donations that they can then meter out over time. One thing to note on that though is we have a separate 60% limitation of AGI on those rather than the full 100% for regular direct cash contributions.
Okay, so that's good to know. Tell me a little bit about the Roth conversion and the limitations that we're hearing about in terms of converting your traditional Roth into your Roth IRA.
Yeah. So just as a recap for people who may be watching, the difference between a traditional IRA and a Roth IRA is in a traditional, when you make the contribution, you generally get a deduction. And so it reduces your taxable income when you make the contribution, the money grows, tax-free. It's not taxed as it earns income within the IRA. And then when you take the money out, you're subject to tax. Whereas a Roth IRA, you don't get a deduction, it grows tax-free, and you get the money out at no tax, zero tax rate. The reason you might want to do a conversion is if you are, there's a few different situations. One may be where you're in a low tax rate this year for whatever reason, extraordinary circumstances, those kinds of things, and you have an opportunity to pay tax on your traditional IRA money and put it into this separate tax protected account at low tax rates, lower than what you anticipate to be in retirement. The other situation that can come up is with estate planning. Very often you have one spouse that might outlive the other, and if you have a large traditional IRA balance, when one of the spouses passes away and this other spouse is taking money out of that traditional IRA, they're paying almost twice as much tax now as when they were married, because their tax rates get cut in half, or the tax brackets get cut in half, excuse me. So those are a couple reasons why you'd want to consider converting just in a general sense. The current rules would limit those and eliminate those for people with very large, well, what we consider now very large balances in IRAs. So if you have more than $10 million in IRA or traditional accounts in aggregate, and you have more than $450,000 of taxable income in a given year, you're subject to these new RMD requirements that I explained a little earlier. Okay. The big risk with that is if you aren't able to plan your income for a given year and you're in that scenario, it can be risky to not take that RMD, and because you might find yourself over those income limitations and then subject to penalties on that RMD, which can be quite severe.
Yeah. So then kind of the last IRA related thing that I've been hearing about is kind of the getting rid of the backdoor Roth loophole, as a number of financial advisors talk about. Can you kind of explain, one, really briefly kind of what that is, and then two, why they're closing that off?
Yeah, certainly. So a backdoor Roth IRA is a strategy where you make a contribution to a traditional IRA when you are not eligible to deduct that contribution. There are income limitations on whether you can deduct a traditional IRA contribution depending on what your income is, and whether you're covered by an employer-sponsored retirement plan. And so there's also limitations on when you can make a Roth contribution. It starts phasing out at about $189,000. They adjust it for inflation on a regular basis. But if your income's over that, you either are limited how much contribution you can make to a Roth, or you're precluded from making a contribution at all. So if you are a person who wants to make additional retirement plan contributions, but you make $250,000, you can't make a deductible traditional because your income's too high, and you can't make a Roth contribution because your income's too high. But what you could do for a very long time now is be able to make a non-deductible traditional IRA contribution. You don't get a tax deduction for that, but then roll that into a Roth IRA almost immediately and not have to pay tax because you didn't get a deduction in the first place. That's a very simplified version of what's going on there. And so Congress is making that illegal now. You won't be able to roll over those contributions anymore. It's also applying to non-qualifying contributions to employer-sponsored plans. So there used to be, well, there currently is what some call a mega backdoor Roth IRA, where you make additional non-deductible contributions to your company 401k plan and then roll those amounts into a Roth IRA, and that also will be eliminated.
So Congress, in their eyes, is seeing this really as something that is hurting those high-income people, but it's also something that could affect a person that's in their, say, mid-50s and is trying to really pump their retirement now that they maybe don't have kids in the house or something like that. Some of the ways we use to create, lots of income into their retirement account in a very short period of time is no longer going to be available.
Correct. It will limit the options for those people who maybe are still working full-time, still have an employer-sponsored plan, and maybe they're even maxing it out, but they still need more in their retirement if they want to be able to retire because of the choices that they had made earlier in their life and or were forced to make earlier in their career. It just takes away that one option available, which currently it's about $12,000 a year for a married couple. The protected retirement plan space that will no longer be available to them.
So then on the business side, Trump had this 20% pass-through deduction in his big Tax Cuts and Job Act. Tell us a little bit about what changes are being proposed to that and kind of what that does for planning.
Yeah. So for big picture, just to refresh everybody's memory, for pass-through entities, those are S corps and partnerships, you are generally eligible for a 20% deduction of whatever your pass-through income is. So your S corp passes through $100,000 to you. You include that $100,000 in your income, but then you get later a $20,000 deduction, which reduces your taxable income. And that's what the QBI deduction is. For a lot of our clients, there are not any limitations on that. You can make $1 billion and qualify for that 20% deduction, assuming you pay sufficient wages to your employees and some other things that come into play. For some of our clients that are what are considered service businesses, there are some limitations that eliminate that deduction entirely over a certain level of income. And effectively what's being proposed in the reconciliation bill, is treating every business subject to those service business limitations. The thresholds are a little different, but any company that makes more than, or any taxpayer that has more than $500,000 of income in a given year will not be eligible for the QBI deduction, regardless of how much in wages they have paid in the past. And so what that means is we're going to have a lot of clients and a lot of businesses that formerly were getting this 20% deduction on their return that will no longer qualify for it, and they'll have a commensurate tax increase even if nothing changes in their business. Yeah. What that can mean from a planning perspective is we may want to do things differently in planning than we've done ever before. Normally when it comes to tax planning, it's all about deferring income and accelerating deductions. We may want to actually reverse that and accelerate income into 2021 where we can get that QBI deduction and defer those deductions into 2022 where we'll be at a higher effective tax rate.
So how does that then, it hasn't passed yet. We're at the beginning of November here, so we still have a little bit of time. Do you think this will all get pushed through in time for us to make decisions based on that, or what do you see as the timing of this?
And that's hard to say. I mean, the original goal was to have everything wrapped up already, according to what the Democratic leaders were talking about. So it's all very much up in the air. I would expect to have some sort of resolution within the next couple of weeks, but it's hard to say for sure. What that might mean is we might want to hedge our bets. We may want to make tax planning decisions that give us some options and some flexibility in what decisions we make as far as when we report the deduction. So perhaps we do buy the equipment, but we wait to make the decision on whether we take accelerated depreciation or not based on what this bill does. If there are other things that can be deferred or paid, it may be you wait till the end of the year to do those transactions, because then we should have some finality to our understanding of what's going to be in effect and what's not.
And some of those things we'd still have to, say, buy the piece of equipment. It's really a choice after the fact of whether or not we take accelerated depreciation on
Correct. Correct. And we're in a very fortunate position from a tax planning perspective that we do have that ability to go and make that decision after the fact with full foreknowledge or pre-knowledge.
Either one works. Yeah.
Being able to make the correct decision at the given time based off of what we know the law actually will be via Section 179 expense and bonus depreciation, or electing not to take those.
Okay. So being an estate and trust guy and working in that area, I know when Biden was first elected, he had a number of proposals that talked about getting rid of step-up in basis on death, a big change in kind of the federal exemption for estate tax purposes. Is this touched any of those areas?
Yeah, so one of the proposals would be to decrease the unified credit for estates, trusts, and gift tax purposes. Currently, it's at the highest level it's ever been. You probably know the exact number, 11 points.
It's over 11 million.
It
changes every year.
They adjust it every year, but it's over 11 million now, and basically it would be cut in half per person. While, again, from the media perspective and how they're spinning it, this is only going to affect not a whole lot of people, but it's something we need to be mindful of, because $6 million today is not going to be $6 million, 10, 20 years from now. And so we need to be mindful of those changes and do what we can to take advantage of. There may be cases where we want to take advantage of the higher unified credit this year through gifting or other things. Prior to this change coming into effect.
Yeah, I think that's a really important point. They've said that if you gift something when the exemption is over $11 million, that gift stays with that 11 million exemption. It doesn't then come back and reduce any sort of reduced unified credit. And so, that gifting, the other thing that's important is if a spouse passes away and they have a surviving spouse, filing estate tax returns, even if they don't have a requirement to do so, to get the federal portability, which essentially moves that $11 million exemption onto the surviving spouse. That stays there if the unified credit goes down. So there's some planning opportunities if a loved one has passed away here this year, or if you've got some assets that you've already started to think about doing some succession planning, some gifting. It might be something to consider doing a little bit more this year if that credit does go down. One of the other things to consider too on that front is, appreciating assets. We don't know where those assets are going to go between where we are today and where the value will be when you pass away. And so keeping that in mind, going from 11 million to 6 million might bring some assets into that pretty quickly. Okay, is there anything else that we should be thinking about as we talk about this bill and kind of what the next steps are watching the news over the next couple of weeks?
So another big thing is there's been a proposed increase in the capital gain rates. So if you do have large capital gains that are sitting in your account, whether it's a brokerage account or real estate or those kinds of things, depending on where you feel you are going to be in the future as far as your tax rate, it may be advisable to do some gain harvesting this year.
So that one of the proposals, gain harvesting, just to clarify, would be selling some stock that I have that has gone up in value because the market's done well right now, that's gone up in value so that I actually recognize the gain here in 2021.
Correct, because your rate in 2021 may be 20% as opposed to the new rate of 25% in the future. Okay. One of the things we want to be careful of is some of the provisions in the bill, their effective date is backdated to when the bill is introduced. I'd actually want to double check that one. So be sure that you are, before you make any kind of decisions like this, you're reaching out to us and we're able to confirm, okay, this is what's being actually proposed, these are the rules around it, so we don't run into any traps. Because a lot of the provisions that we've been talking about are effective as of 1/1/2022. So we still have the next 60 days to do some tax planning and make some moves to optimize our tax position. But there are some provisions that are backdated back to middle of September, and we've already passed that, and there's nothing we can do about it. Another big change for small business owners is another revenue raising proposal was to make the pass-through income from trades or businesses, even if you actively participate, be subject to the net investment income tax. So the net investment income tax is that 3.8%
tax on what historically has been passive activities. So now they're making that related to corporations and partnerships that are active?
Correct. And when you combine that with the loss of the QBI deduction that people subject to that tax will also be dealing with, you have a very large marginal effective tax rate increase on small business owners if you fall into the income ranges that are subject to this. This income range for net investment income tax is lower than the QBI phase out that we discussed earlier. QBI goes away after $500,000 of income under the proposed law. Net invested income tax comes into play at $250,000 of taxable income. So you're going to be running into some situations where you're going to be subject to this net investment income tax, this extra 3.8%. And then you're going to have other clients that are not only going to be subject to that, but also effectively a 20% increase in their tax rate on their business income.
Wow. So if I'm a shareholder in a company and our net profit is, let's say, $600,000, is that at the company level, or is that at each shareholder, and depending on the percentage, I may or may not have that as an individual shareholder?
That's a good question. So for flow-through entities like an S corporation, those additional taxes that we've been talking about are going to be assessed at the individual level. So you might have some shareholders that are at a very high tax rate and some shareholders that are not affected at all by this new law, depending on what their other income looks like. There are some proposed changes to C corporations as well that could affect many of our clients. They're going back to a graduated income tax rate schedule where the new low rate will be 18%, then it goes to the current 21%, and then it goes up to 28%.
Wow.
And so that's going to introduce some additional complexity for those entities as well.
Yeah, so it's interesting when we're talking about splitting up income from an S corporation. We have a family-owned business, let's say. Husband and wife have been the owners of the S corp, but now Johnny and Sally are getting old enough that they're starting to participate, and maybe there's some succession planning. We've talked about gifting ahead of time, and then with this net investment income tax, is there some considerations of gifting and getting that income split out?
Yeah, I mean, that might be something to look at, is if you have either other family members or key employees or those kinds of things that are going to be part of your succession plan, maybe getting them on board sooner rather than at some indeterminate point in the future can allow everybody to stay under these new tax increases and significantly lower the tax burden on individuals who own S corporations.
Yeah, that makes sense in a number of potential cases. And one of the other things is we know that so many times nothing is ever permanent in tax law. Now, this is a reconciliation bill where all of these are being proposed. And so is there time limits on some of these things? Are these the quasi-permanent changes we've seen in the past? Where are we at on timelines?
Yeah, most of these proposals, from what I have seen and understand, is these are meant to be permanent. Okay. The revenue raising side of things is permanent. The spending side of things are what's temporary. Because as part of the reconciliation process, you can raise as much revenue as you want forever. It's the spending side of things where they have to ride that fine line over a 10-year fiscal period of not spending too much money or adding too much to the deficit. And so pretty much all these revenue raising procedures are permanent as far as the law is concerned. There's none of them sunset or anything like that.
Got it. Well, thank you, Don, for taking some time here today and helping us stay up to speed on the changes. We hope that you've taken an opportunity to hear some of these out. Maybe it's raised some questions that we didn't touch on. Our staff is ready to help you answer what we can. There's still a lot of unknowns. And then there's also changes happening as the legislative bodies negotiate where this all is going to fall out. So we'll keep you posted as well as we can as things change, and then once we start to hear kind of what actually is in the final signed bill as that comes out. But in the meantime, if something you heard today brought up questions, or you want to kind of take that conversation further, feel free to reach out to us. We'd be happy to talk to you about that. Thanks again, and we'll see you soon.